Welcome back to the IB Investor channel. In this video, we'll take a look at Paradox Interactive's most recent quarter. We'll cover the share price development, the sales and profitability, the cash flows, debt situation, the dividend, and the CEO remark. The company does have a long origin story from in the 1980s. But this company, the Paradox Interactive company, the games company, was founded in 1999 in Sweden. The company has a market cap of about 22.6 billion Swedish kroners. It is listed on First North. The ticker symbol is PDX, and the industry is gaming. Now for the share price development, and we can see that the share has returned quite a good return for almost 370% for the maximum period here, and we can see that the stock was listed here in 2016 or so. So ever since, the stock has done pretty well for itself. However, as you can see, it's been a pretty bumpy ride with many tops and downs. So here we see that the stock has traded around 321.6, which is the all-time high level, but we can certainly see here that it trades roughly at around 200 kroners or so right now. And if we look at the total returns here, including dividends, for the 1 year return here, almost 13%, but for 3-year return here, total return minus 22%, so negative here actually. And for the 5-year total return, 63.1%. So the stock has done pretty okay, all things considered, but as you can see, if you bought it at the wrong time here, you're probably in the red. So buying it here at one of these tops has never been a good idea. So if you want to trade the stock or something like this, you should certainly look for the bottoms here. Obviously, easier said than done, but if you bought at the lower levels here, you probably made some money at least. Now for the income statement of this company. So we have the blue line here, which is the net sales, and we can see that the net sales has been growing along pretty well over time. There has been some slips here in 2021. We can also see here that the earnings per share has been growing pretty nicely, except for 2021 here, where we had a big decline from the previous year here in 2020. We can also see here recently that they had a decline in EPS for the most recent quarter here. We can also see that the gross margins here are not so high actually as I expected, sitting at 50.2%, which is, it's still a tech company, so I would have assumed that it was higher, but currently at 50%, which isn't bad per se. But we've seen here in 2016, 2017, you can't see it from your end, but during this period they had a gross margin of 65.5%, which is more than 15 percentage point higher. So this company has had a history of higher gross margin, and I think management needs to come back to this level if they ever want to raise the profitability higher. And speaking of the profit margin here, they have a 28.1% profit margin here, but they did achieve a much higher profit margin here in 2016, where it's sat at 36.8%. So certainly producing more earnings here for their shareholders right here. And then the off year here in 2021, it was down to 17.1%. So yeah, they have had some bad years in the past, but currently it's at a pretty decent 28.1%. So any industry company would look at this number and be jealous of these type of companies for sure. Now for the free cash flow margin, and we can see that this company sits at a 14.3%, which is, I would say strong double-digit number here in the lower teens, but still very good. And we can see that historically speaking, they've done pretty well for themselves as well. So this is, double-digit in the 20s, so very good here. They've had some off years here. You remember 2021 on the income statement was bad, and we can see it here in the free cash flow margin. Paint to the same story here. But this is the potential here, going up to 20% plus. So this is, in my opinion, management's goal here, that they should increase it over time, because this is a good level. We can also compare it here to EG7 that sits at a 23.3%, and Embracer Group here that sits at a negative 21.1%. So pretty bad from this peer, but at least they have some competition here from EG7. Now for the free cash flow per share, we can see that here in kroners, it's currently at 3 kroners, which is lower than previous periods, but it paints pretty much the same picture as the free cash flow margin. We can also see here concerning the share count here, there's not been any dilution. So they're basically sitting at almost the same share count here for this period. So no dilution at all for shareholders, which is good. However, we can see that the free cash flow yield is quite low here at 1.4%. And, you know, anything above 4% for a growing company is pretty good. So a 1.4% yield is just the first indication that this company might be overvalued right now, actually. Now for the cash flow overview, and we can see here that the cash from operations in blue have been growing steadily over time. Obviously here the off year in 2021, as we saw earlier on the income statement, it did decrease the cash from operations here by quite a bit from the prior year here, but still they're growing, and in the most recent quarter here they posted a all-time high cash from operations, which is very good to see. For the capex side here, we can see that they've kept on investing during this period steadily increasing year over year, almost every year here, and right now almost 1 billion here in capex, which, you know, it's not bad, it's not good. I don't know, I'm not so good at assessing gaming companies, but I guess they have to invest in new games in order to, you know, make new releases and obviously new sales and attract new customers. So capex is expected from any company. We can also see here still that they posted a nice free cash flow here at 317 million Swedish kroners, but it's not as good as here where we've seen that they actually did post a higher free cash flow. But my assessment when looking at the cash flows right now, nothing alarming right now. Now for the net debt versus the cash from operations, and beginning here with the net debt, we can see that it's negative, which is very good because that means that they have more cash than debt right now, which is good to see. It's not very often you see these type of companies. So very good here from management that they have not, you know, let their balance sheet, you know, be exposed here. We can also see here that the cash from operations is increasing as we saw on the previous slides. So nothing to be alarmed here for investors. It looks very, very good from a debt point of view here. This paints a similar picture, continuing here with the debt. So here we have the net debt to EBITDA that currently in the most recent quarter here sits at negative 0.57 times, which is very low and good. As long as it's negative here, it means that the financial health here for the company is very, very good. Obviously, it's been lower or more in the negative side here in past years, but, you know, still a minus or negative 0.57 times multiple is very, very good. So financially speaking, once again, this company is in good health condition here. Comparing it here to EG7, also quite good multiple here at negative 0.77 times, sorry. And then Embracer Group here at 2.2 times net debt to EBITDA, so much higher. So Embracer here is a much more difficult situation here with the net debt here. So yeah, but looking at this from Paradox perspective, it looks really good actually. Now for the enterprise value to EBIT, we can see that this company actually trades at a pretty high multiple here at 27.3 times. And the company has been pretty, you know, overvalued in my opinion when looking back here as well in the past. So this company has never really been cheap except for here 2016, where you can actually buy it at a, you know, good value proposition. So, you know, anything below 20 for this company, as long as it's growing, is probably a good value proposition. But right now, I would say that this stock could probably go down like 25, maybe 30% before it actually looks like a good value to me. But this is just looking at one multiple here, or one KPI. So this doesn't paint the whole story, but, you know, this is a pretty good KPI to, you know, just in the short term at least, to get a fast valuation on the company. Here also comparing it to EG7 that sits at a massive 32 times multiple, and then Embracer Group even worse at 42 times EV to EBIT multiple here. So the peers are actually valued at much higher multiples here. So comparing at least apples to apples here, then at least Paradox looks like a bargain compared to these two. But this number in itself is pretty high, and I want investors and speculators to be aware of that. Now for the return on invested capital, and they currently sit at 31.3%, which is actually very, very good. And it has been pretty massive over time here. So, I mean, looking at this and comparing it then to the overvaluation, maybe it actually, it could be worth it because they're getting a lot of profits from the investments that they're doing. So, like, yeah, it is what it is. Sometimes for a quality company such as Paradox, I would assume at least you're gonna have to pay up. And this is one of those KPIs that just proves that management, historically speaking, has done a very good job here to invest the capital here and get good returns for the profit side. And one off year here, we talked about this previously in 2021 in the income statement, but yeah, they had a bad year here, obviously in 2021, and it shows also in the return on invested capital here. And then comparing it to some peers here, EG7 and Embracer Group, so 2.9% for EG7 and Embracer Group at 7.9%. So you can see that these companies, the management here, are doing a much worse job, if you will. So their return on invested capital is much lower, especially here for EG7. So yeah, just comparing it apples to apples here. Now for the dividend per share in terms of kroners here, we can see that they have been pretty inconsistent when it comes to growing the dividend, but at least it's been very consistent in terms of paying a dividend at least. So Paradox has paid a dividend ever since they got listed here, it looks like. However, in the past year here, they actually did increase the dividend here by 100%, so going from 1 kronor a share to 2 kronor a share here. So the board has awarded their shareholders here with some dividends. But looking at the dividend yield here, you can see that the company actually, only trades at a less than 1% dividend yield, which is very low. But we can see, though, however, that the payout ratio for this company is quite high at 33.7%. So, if they were to double this, they would sit at a 66 or 67% payout ratio and only offering, a 2% dividend yield. So I would say that right now this also indicates that perhaps the company is a little bit overvalued in terms of share price right now, at least. So, but yeah, I would say that this is for the dividend growing guys, it's kind of inconsistent here, but at least for the guys who wants a consistent dividend paying stock, Paradox is probably a good option here. Now for the CEO remark, and I did have to summarize this a little bit because it didn't fit on a page otherwise, but he's saying here that the third quarter of 2023 was the thinnest in terms of releases, but a lot of the focus was on the future, so that means that in this quarter is probably a pretty calm quarter for them in terms of releases here, it says. The revenues were driven mainly by catalog sales and sales activities, while the costs were higher than usual due to marketing for upcoming games. So they did release here, as we can see, the Skyline 2 here, which was probably one of the reasons why they had a lot of marketing costs here in this quarter, and it's probably going to remain for this quarter as well, because this game, the impression that I received so far is that the game isn't so good as the number one game here, the Skylines 1 or Skylines Original, if you will. So it's going to be interesting to see. He also mentioned here that they had some disappointing sales to some other game here, which is called Lamplighters League, which led to a write-down of development costs. So that means that all the money that they spent on capex for this game in terms of development, they wrote it down here. They also announced here that 2 new game titles for next year, Millennia and Foundry. The CEO also says here the importance of player engagement over time and the strategy of stock up and breakout for risk-taking portfolio expansion. So he's kind of upfront here, but about this quarter not being perhaps the best, but he looks up here, heads forward or eyes forward. So they have a lot of challenges here, and they're going to have to fix this game here, as he's saying. the city skylines too. They have to, improve the game, develop the game further, to make the player base here happy, because so far the game hasn't received the attention, or the positive attention, if you will, that I think management and the player base had expected. So some challenges here, some headwinds certainly here that the CEO will have to dig into. All right, this was it for this Paradox Interactive video. If you liked the video, please hit the like button below and subscribe to the channel if you want to see more content going forwards. Thank you very much for watching and have a very nice day.